Hey guys, welcome back to the Capital Mindset Show. So today we're doing another subscriber request, and this one's a REIT. This one's kind of a unique REIT, and the name is Iron Mountain, ticker symbol IRM. So with Iron Mountain, as always, we'll begin with the price action and show you guys what's been going on. So more recently, they had a little bit of a pullback, right, year to date. So they were above $51 a share. I think they hit, 52. They're down about 15% from their all-time highs. And looking forward at the longer term, we saw a company that basically had a long period of stagnation, heavily underperformed the market. So already there, unfortunately, if you had owned this company, that is a massive, massive, massive opportunity cost. Okay. And what do I mean by opportunity cost? People need to really appreciate what it is when we're kind of analyzing the opportunity cost. Well, it's not a real cost. It is the cost that you are basically giving up had you otherwise been doing something else, right? And when we invest, opportunity cost is very important to consider, right? Because a lot of people will say, just leave it there and whatever happens. Okay. Well, if you made, let's say 5% in that investment, the real cost isn't measured in that 5%. The real cost is kind of more metaphysical in a way, but it's in essence what you could have done otherwise. Okay. And of course, you want to have a baseline, right? You can't say, oh, I would have invested in this stock no one knew about, and I would have made a million%. No, but you didn't know about that company. Okay. But for example, the SPY, right? Or other forms of indexation. Those are opportunities available to you at the present moment that you are aware of. So then those are proper comparisons to make. You can't compare a stock that you've never heard of. Okay. So let's be clear on that. That's what I mean by opportunity cost. And that's typically what we mean when we are using that as a comparison, the SPY, the NASDAQ, et cetera. So that being said, if you had been an investor more recently, you did really well. Let's take a look at that. That's about 82%. All right. You did pretty well. And you scored a nice dividend because this is a REIT. So the majority of their cash flows are going to be focused on paying out that dividend. And for those of you who may not know, a REIT basically is a legal entity in which the taxes do not flow onto the business. It's a pass-through entity. And so the taxes flow to you as the investor, and the dividends are taxed as ordinary capital. Ordinary income. I almost said ordinary capital gains. That would have been wrong. Ordinary income. And the entity itself doesn't pay any taxes. Now, part of the stipulations included in that structure of being considered a REIT is 90% of your taxable income must be distributed to the investors. Okay. So taxable income, that's the key. And then we have to distinguish taxable income from cash flows. They can still distribute 90% of their taxable income, but only distribute 50% of their cash flows in the form of dividends, right? How does this happen? Well, a lot of non-cash expenses are included in that. Okay. So that's a little tidbit about Iron Mountain. So let's actually take a look at the investor presentation. This is the sales pitch. Let's get to know this business a little bit better. So overview of the business. All right, that's what I want. Give me the overview. All right, so we have global presence, cool, significant size and scale. All right, if they don't mention it, I'll mention it for you guys. But basically, they store information. So they have data center business. They have the documentation storage. They have a very big facility, for example, where they store a lot of paper documents that are very sensitive. They have a big reputation for that. Back in my wee old days when I used to work at Chase or JP Morgan, they would actually be the ones that was, I guess, working with the firm and taking documentation out. So that's my experience with them. That's the only time I've ever seen them. They'd always have like these big boxes, and you would put the sensitive information into the box if it's to be discarded. But because it has sensitive information, it has to go in that box. Iron Mountain would come and they would take that box and then, do something with it. Whatever. I didn't really know what happened to it. So we see that the revenue breakdown is actually put like this. And okay, these colors shouldn't be bad. For those of you who may not know, I am colorblind. So it's okay. So it's basically I can see colors, but some colors I'll mix up. But if I mispronounce or misrepresent a color on video, you guys know. Okay. You guys can roast me in the comments. So records management is what I was discussing. So that's like the paper, the physical copy. They even store like music, stuff like that, the original recordings of music. So that's in the records management. Data management is the fastest growing segment, or it should be, because in the globe, that is the fastest growing segment. So it is also their second large storage business. And then there's a service business, and we'll discuss kind of the differences between them. So secure shred, this is what I had experience with. So it was probably they were taking it over and then they were going to destroy it in a secure manner. And then we have data center, data management. Those are kind of like coincided with one another. Data center is basically like, storing or housing servers, stuff like that. Data management is actually holding the data and then giving it to you when you want it, right, upon request, stuff like that. So this is kind of what you can think of with their traditional business. They would have these facilities where you would store documents, sensitive documents. And you see here, they remain for 15 years on average. So this is basically cash cow. They just have a warehouse, a very secure warehouse, and they put it all in there. So, and once you're there, there's very low likelihood you are going to exit. But again, this is the cash cow of the business. And when someone refers to the cash cow, the technical definition of a cash cow is basically a mature business, right? A mature part of the business that just generates cash flow. And then that cash is either redistributed because there's not much more investment to do in that part of the business. And you can take that cash again, distribute it to shareholders, or invest it in other businesses. So that's what they're basically doing with that. And then here we have the consumer segment. Again, it's pretty small. I doubt most of us are doing business with Iron Mountain. Adjacent businesses. Okay, cool. And then records information management. So this is storage volume. So this is what's stored in their vaults per se. Okay, so going forward from here, we see their expansion into India. Okay, very important. I want to see them expanding into other markets. So good on them. This is good if you're looking at it from that perspective. Again, this is a REIT, so they are buying real estate. Okay, remember, data center REITs are a thing, and then we have this, which is kind of data center and traditional paper storage centers. Okay, so we see anything else that's not really that much interesting here. Long-term target leverage ratio. Okay, we'll make sure that they're getting there in the model. Okay, anyone can say this. That's a buzzword. And balance sheet remains well positioned. Okay, this is good. Fixed rate debt. Why would I care about that? Well, I'll pause for a moment for everyone to think, and then I'll say, well, the reason why I care about that is if rates go up, that won't go up. Okay, very simple. And you can think of this as a variable loan. So if you have a variable loan, that can be quite dangerous if rates are going upwards, right? So we don't want to see a lot of the debt not being at a fixed rate. Okay, 4.5% average interest rate. This seems high relative to other companies we've seen. Yes, it is high. So basically, I expect that their cost of capital is going to be quite high because I think their dividend's about 5%. So every time they issue equity at the current price, they're paying 5% on that going forward. And if they take on debt, it looks like they're taking about on average 4.5%. So I'd rather see them go debt heavy than share heavy. And we will see if they're doing that in the model. All right. So and then let's just go to the model from here because we don't need to care about that. So let's start with the ratios and let's actually grade management on their claims, right? So right here, this one, we're going to ignore the liquidity ratios. This is a REIT, all right? So some of the calculations are, a little bit wonky, but let's take a look at the long-term debt ratio. All right, so it is coming down. Okay, good on them. Barely, but it is. Well, total debt ratio has gone up though. So the liabilities have risen. And then the long-term debt to capital has risen. Okay, not looking too good, guys. Operating margins have actually declined. Okay, this is interesting because the share price is up, but the operating margins are down. Net profit margin going up. We don't really care about that because it's a REIT, but good to know. Okay. And ROE, ROA. ROE looks pretty good. Okay, going down here. Okay, pretty good grade. It's declining, but it's still good. You're not supposed to look at it as necessarily a terrible thing. You just don't want to see it below 1. Okay, below 1 would be a bad score. And then we don't really care about that, the activity ratios. Okay, so let's take a look at some of the analysts, what they say. They say it's a buy with, I guess they need to update that. But the buy rating was there and looks like they were right in the short term, about 80% price improvement, So not the best performer, but a decent performer. And then we see here, yep, you see that they are utilizing barely any shares. Okay, barely any shares. Good, right? Because that's what I was talking about in the presentation. The cost of issuing new shares is actually more than the debt. So I want them to be debt heavy, and they're debt heavy. Awesome. This is good. But they are still diluting you, just barely though. Okay, and we do want to see AFFO growth. Okay, sorry, FFO growth. Okay, so that's been the average growth rate. So let's actually put that in. And basically the model, if that's our center, right, then it's decently overvalued. Okay, at the present moment, if I'm assuming a 15% required rate of return, and this is kind of coinciding with my general thoughts on REITs at the moment. With rates so low, they are very expensive, right? If we're valuing the cash flows, right, we have to take into account the cash flows and discount the future cash flows to the present moment and get that value. With rates so low, all the REITs are going to be trading at decent premiums. If rates ever rise, this is not going to be good. Okay, so a lot of risk is implicit in REITs at the moment, which is unfortunate because they've been really good performers. But simultaneously, since the 80s, rates have been coming down. So you had the macro tailwind for REITs throughout most of people's lives right now. A lot of the Gen Xers. And it's hard to say it, but like right now, things can change, right? So you want to be aware of that. And then the prices of REITs are properly articulating this reality. So we want to be careful with that. And we see that the properties have, a decent cap rate, right? Because cap rate is the price of the property or the value of the property, and then measuring the rent on that property. So these properties have high cap rates, right? Industrial properties right now have very low cap rates, but data centers, stuff like that, they have a little bit higher. Well, especially Iron Mountains because they have warehouses where they just store paper. That's and I say paper, you know what I mean, but records and stuff like that. That's going to be a little bit higher cap rate. So all in all, what I would say about this business, okay, as a summary, it's interesting. It's performed really well. Congratulations if you've been invested in it thus far, but I don't think it's for me personally going forward. I think that I have to contend with the potential possibility of rising rates if that were to happen, or even the threat of it, that would drive down prices of REITs, right? So all REITs are basically priced for this. If, however, you got it at the lower prices where it did reach, by the way, that would actually be, for me, a good moment to enter because it's still putting that proper discount on the cash flows going forward. And I'm comfortable with that. And I'm comfortable with assuming about a 4% growth rate. I think that that's doable because they have the cash cow and then they have the growing data center business. Okay. So that's more or less my opinion. Please comment down below if I missed anything or if you guys have any questions on any little details that we discussed in this video. If you guys have any other recommendations as to what you'd like me to look into, feel free to comment down below. Remember, micro caps, not really going to do those unless there's a unique learning moment from those micro caps or they're in a unique situation. Try to avoid biotech stuff because biotech stuff is basically a lot of speculation. And again, we're doing that because going forward as the channel grows, I don't want to have to or seem like I'm promoting anything. Okay. And we got to be careful with the micro caps out there. So with that being said, guys, thank you guys so much. If this video provide value to you, feel free to leave a like and share it if someone's actually looking into this company. If not, if it's a terrible video, just leave it into the nether and then it will stay here forever. So thanks, guys. Have a good one. Bye.
you.